Hey there, risk managers. In our world, reinsurance is often seen as this incredible, almost magical tool, a real lifeline for capital and risk management, isn't it?
It really is. It's fundamental.
It's what allows insurers to balance their books, spread colossal risks, and, well, fundamentally keep the whole financial system stable. But with the shift to a truly risk-based regime, like Solvency II,
Things have changed.
exactly, and the rise of what our friends at 𝗖𝗋𝗶𝗍 are calling non-traditional risk mitigation techniques, things have gotten a lot more complex and, frankly, a lot more scrutinized. Today, we're taking a deep dive into some critical new guidance from 𝗖𝗋𝗶𝗍, specifically focusing on the intricate dance of mass lapse reinsurance and, perhaps even more crucially, those sometimes hidden pitfalls lurking within reinsurance agreement termination clauses.
Right. Those termination clauses can be tricky.
Get ready to truly understand what effective risk transfer means when regulators are, well, watching your every move.
Absolutely. Our mission today is to help you cut through that complexity, to extract the essential insights from 𝗖𝗋𝗶𝗍's recent opinions on these very topics. We're going to help you grasp not just what the rules are, but why they matter and the profound implications they have for your firm's solvency capital requirements,
SCR.
its operational resilience, and even its broader governance framework. Because let's be clear, we're talking about real capital at stake.
Huge amounts.
And ensuring your risk mitigation genuinely delivers the robust protection it's supposed to, rather than, an illusion of safety.
A paper tiger, essentially.
Precisely. The evolving landscape of reinsurance and risk mitigation.
Let's kick things off with the big picture then. Why is reinsurance such a crucial tool in the first place, beyond just the obvious idea of sharing risk?
Right.
Because on the surface, it seems like a straightforward concept, but there's so much more beneath that initial idea of simply passing off a portion of risk.
You've hit on a fundamental truth there. Reinsurance isn't just about shifting a portion of a single risk. It's the very backbone of the global insurance ecosystem.
The backbone, okay.
Think of it as a multi-tool for an insurer. First, it enables broad risk diversification across an insurer's entire portfolio. That lets them take on a more diverse range of policies without, over-concentrating risk in any one area.
Makes sense. Trends the bet.
Exactly. Second, it provides access to essential additional underwriting capacity. This is vital for portfolio expansion, allowing an insurer to write more business, to grow, and to serve more customers than their own capital base might otherwise support. It's really the engine for growth.
Right, lets them punch above their weight, capital-wise.
Third, it plays a critical role in addressing protection gaps in the market, making it possible to cover risks that might otherwise be uninsurable or simply too large for any one insurer to handle alone.
Like catastrophes.
Exactly, whether it's a catastrophic natural disaster or a complex emerging liability. And ultimately, this all coalesces to increase financial stability across the entire industry. It acts as a profound shock absorber in times of crisis.
A shock absorber, I like that.
It is, quite simply, the mechanism that allows insurance undertakings to operate and provide the extensive coverage to individuals and businesses globally that we rely on. Without it, the scale and scope of insurance as we know it would, well, it just wouldn't be possible.
So it's vital, indeed, a veritable cornerstone of the industry. But you mentioned non-traditional techniques and 𝗖𝗋𝗶𝗍's increased focus on them. What's driving this heightened scrutiny from regulators? What has changed?
Well, it largely stems from the transition to a more stringent, truly risk-based regime like Solvency II in Europe.
Okay.
This paradigm shift naturally led undertakings to explore a broader range of risk mitigation techniques, RMTs as they call them.
Right, RMTs.
Many of these techniques weren't as frequently used in the past, or their application has become far more sophisticated and complex.
More bells and whistles.
Kind of, and 𝗖𝗋𝗶𝗍's core concern, clearly outlined in their 2021 opinion on the use of RMTs, is ensuring a fundamental principle of Solvency II: consistency.
Consistency between what?
Specifically, consistency between the actual risk transfer achieved by an RMT and the corresponding effects on the solvency capital requirement, the SCR.
Ah, okay. So the relief has to match the reality.
Precisely. Regulators want to ensure that if your firm gets capital relief, that relief genuinely reflects a real reduction in the firm's underlying risk, not just a theoretical one on paper.
Okay, let's unpack this. So if an RMT, like a reinsurance treaty, doesn't genuinely transfer risk commensurate with the SCR reduction, or if it inadvertently introduces new risks you hadn't accounted for, it's simply not considered effective in the eyes of the regulator. To put it bluntly, you could be holding a reinsurance agreement that, on paper, promises significant capital relief, but in a real-world stress scenario, it might just be an expensive piece of paper.
That's it, exactly.
It's the illusion of safety, not the reality. That's a fundamental vulnerability, isn't it?
Precisely. It's absolutely a fundamental vulnerability. If the capital relief calculated in the SCR doesn't align with the actual extent of risk that has been transferred.
The economic substance.
Right. Or if the treatment within the SCR is inappropriate because the RMT itself has acquired or created new, perhaps unquantified, risks in the process, then the technique fundamentally fails to provide effective risk transfer.
Wow.
This isn't just a technicality, it's a critical principle for regulatory compliance. It means you can't just slap on a reinsurance treaty and assume the capital benefits will follow. You have to robustly prove that the economic reality of the risk transfer genuinely matches the regulatory accounting. Your solvency position hinges on it.
And today, our spotlight is on mass lapse reinsurance, a very specific type of RMT that's gaining increasing attention. Before we get into how it works, what exactly is lapse risk in the Solvency II context? It's far more complex than a single policyholder deciding to cancel their car insurance, isn't it?
Indeed, it's far more nuanced than that. Solvency II defines lapse risk broadly. It encompasses the potential for losses or adverse changes in the value of insurance liabilities resulting from fluctuations in the level or volatility of policy lapses, terminations, renewals, and surrenders.
So a lot of ways policies can end or change.
Exactly. Now, while the legal definition technically applies to health and non-life business as well, mass lapse reinsurance is predominantly relevant for life business.
Why life specifically?
Well, the reasons are multifaceted. Life insurance contracts typically have much longer boundaries, meaning these liabilities persist for decades. And crucially, the mass lapse scenario within the standard formula often leads to a substantial capital requirement in the life segment.
A bigger hit to the SCR.
Right, sometimes showing a strong dependency on prevailing economic conditions, like interest rates. This is why our analysis today focuses primarily on life lapse risk, though the underlying principles can certainly extend to health and non-life where analogous situations arise.
So it's not just about an individual policyholder deciding to cancel. It's a mass event, a systemic shock to the portfolio. How does the standard formula capture this kind of widespread, simultaneous policyholder behavior?
Okay, so the standard formula, part of Solvency II's framework, outlines how to calculate the capital requirement for lapse risk. It defines it as the maximum of 3 scenario-based requirements.
3 scenarios.
Yes. You have a scenario for a permanent increase in lapse rates, one for a permanent decrease.
Wait, a decrease can be bad too.
It can, depending on the product profitability. But the big one for our discussion today is the third scenario. A mass lapse scenario.
Main event.
This mass lapse is defined as a combination of instantaneous severe events. For most undertakings, Solvency II requires applying a significant 40% stress for mass lapse risk.
40%, that's huge.
It is. It means a sudden, dramatic increase in policy discontinuances across the portfolio. And for the management of group pension funds, that percentage actually jumps to 70%.
70? Wow.
Yeah, reflecting their unique sensitivities. In many cases, especially when prevailing risk-free interest rates are higher than guaranteed rates on the policies, this mass lapse scenario frequently dominates the overall capital requirement calculation for an insurer. It's the big one that keeps actuaries awake at night.
Here's where it gets really interesting, though. This mass lapse event, as you said, isn't about regular day-to-day policyholder churn. It's designed to capture non-structural changes. What does that mean in practice for risk managers, and why is that distinction so important when you're looking at your capital requirements?
That distinction is absolutely vital because it speaks to the very nature of the risk being covered. Think of it this way. A structural change might be a long-term economic shift that slowly but permanently alters how people view insurance products, leading to a gradual, sustained trend in lapses.
Like demographics changing, maybe?
Perhaps, yeah. A non-structural change, however, is like a sudden, unexpected shock, a major financial scandal hitting the industry, a specific adverse legislative change, or an unforeseen market dislocation that causes an immediate but potentially temporary surge in lapses.
A spike, not a slow burn.
Exactly. It's about a sharp, unusual spike, not a gradual, sustained trend. The standard formula's mass lapse scenario was specifically included to capture these temporary and drastic rises in lapse rates, contrasting them with scenarios covering permanent changes. Now, While the standard formula typically assumes these events are instantaneous for calculation purposes, 𝗖𝗂𝗃𝗍 acknowledges that these mass lapse events can manifest over a longer period in reality, sometimes well beyond the typical 12-month SCR horizon.
But it might not be over in a year.
It might not be. This is particularly true if they're a delayed reaction to a very severe 1 in 200-year event that unfolds over time rather than an immediate discrete shock. Understanding this temporal dimension is key for effective risk modeling and, well, for assessing the efficacy of your mitigation strategies.
And that's precisely where mass lapse reinsurance, or MLR, comes in. Given this very specific and extreme nature of the risk it's meant to cover, how does MLR aim to mitigate this particular mass lapse scenario?
Okay, so MLR is typically structured as a non-proportional reinsurance treaty.
Non-proportional meaning?
Meaning the reinsurer doesn't take a proportional share of every policy. Instead, they cover losses above a certain threshold.
An excess of loss structure.
Essentially, yes. It's explicitly designed to cover part of this extreme mass lapse scenario we've just discussed. The treaty usually defines an attachment point, which is a lapse rate over your assumed best estimate lapse rate.
The trigger point.
Right. And then a detachment point, which sets the upper limit of the cover. The protection offered by the treaty is commonly calibrated to that 40% mass lapse stress point that the delegated regulation sets out. So in a practical example, if your attachment point is 15% and your detachment point is 40%, both measured over your best estimate lapse rates, the treaty would cover your losses that arise from lapses occurring specifically within that range, between those 2 points.
So only the losses in that 15% to 40% band.
Correct. It's a targeted cover for those most extreme tail-end lapse events. 2. SCR treatment and the assessment of MLR treaties, addressing basis risk.
So the goal for an undertaking for your firm is clear. Reduce its solvency capital required by using MLR. But this isn't a simple calculation where you plug in a number, is it?
Not at all.
It all hinges on demonstrating effective risk transfer without creating material basis risk. What exactly is basis risk in this context, and why is it so incredibly critical for achieving that SCR reduction without regulatory pushback?
Basis risk in this context is the critical mismatch that can, well, derail your capital relief. It's the divergence between the specific risk covered by the MLR treaty and the actual underlying risk exposure you're trying to mitigate for Solvency II purposes.
The gap between the contract and reality.
Precisely. Undertakings are fundamentally required to demonstrate, based on their own unique and specific risk profile, that the treaty genuinely provides effective risk transfer that is commensurate with the capital relief sought. And crucially, it must do so without creating material basis risk.
Material basis risk?
Yes. If that alignment isn't there, if the reinsurance doesn't perfectly fit your specific exposure, the capital relief you've booked might not hold up under supervisory scrutiny. It's the difference between genuine protection and, as you said, a paper tiger.
So it's not a generic assessment you can just apply across the board. It's intensely specific to your business model, your distribution channels, the types of liabilities you hold, your customer demographics.
Exactly.
It sounds like a deeply individualized analysis is needed here. This is where the deep dive truly happens for your firm.
Absolutely. It's not a one-size-fits-all solution, and that's a key takeaway for risk managers. Undertakings willing to use MLR treaties must have a specific and robust risk assessment process in place. They need to meticulously analyze all surrenders and discontinuance options they are exposed to, assessing them based on their materiality to your firm.
Okay.
Where basis risk does exist, you must comprehensively assess its materiality. This involves checking if the MLR treaty's cover closely mirrors the changes in the value of the risk exposure within the defined lapse rate range, that is, between the attachment and detachment points.
How do you do that?
Well, this isn't a simple tick box exercise. It requires a comprehensive set of risk scenarios consistent with the 99.5% confidence level of Solvency II. And these scenarios must include potential structural changes in the economic environment.
So really stressing the models.
You have to. And the results of this rigorous assessment must then be part of your regular supervisory reporting. It's about proving the economic substance of the transfer, not just the legal form.
And if that risk mitigating effect can't be accurately measured, or if there's simply too much ambiguity, you just can't consider the treaty as an RMT for SCR calculation purposes.
That's absolutely right.
That's a huge potential pitfall for firms that might be banking on that capital relief.
It is indeed a huge potential pitfall. If you cannot accurately measure the risk mitigating effect, then the treaty cannot be recognized for SCR reduction. This often necessitates a deeply detailed and granular analysis of the specific terms and conditions of the MLR treaty.
I get into the weeds.
Absolutely. You need to consider Every clause, every definition, because even a seemingly minor deviation can introduce a material mismatch. Furthermore, undertakings should consistently apply 𝗖𝗂𝗃𝗍's guidelines on basis risk in this context, which provide additional guidance on how to identify and quantify these mismatches. It's a complex area, and a superficial review simply won't suffice when your solvency capital is on the line.
All right, let's put on our detective hats. When you're handed an MLR treaty, where do you start looking for these hidden risks? What's the very first line of defense against basis risk? I imagine it starts with the most fundamental aspect of any contract, 2.1. Clear and incontrovertible terms and conditions.
You've got it. This point might seem obvious on the surface, almost too basic, but it is the foundational bedrock for any effective risk transfer.
Back to basics.
Exactly. The contractual arrangements of the MLR treaty must be unequivocally clear and incontrovertible. Any lack of clarity or ambiguity introduces significant legal risk and inherently compromises the effectiveness of the intended risk transfer.
How so?
Well, if the definitions of the claim, the scope of cover, or the triggers are incomplete or unclear, it could lead to a situation where the risk transfer is either significantly limited or, worse, completely non-effective. Ambiguity can lead to costly and time-consuming disputes precisely when you need the cover the most.
The worst possible time.
Entirely defeating the purpose of the RMT and leaving you exposed. 2.2. Lapse. Definition.
Okay, next up, the definition of lapse. Solvency Summon has a remarkably comprehensive definition of discontinuance, covering everything from active surrenders to policies becoming paid up and various other continuity options. What happens if the MLR treaty's definition of lapse isn't perfectly aligned with this broad Solvency Summon concept? It feels like an immediate area for misalignment.
It absolutely is, and this is a prime area where material basis risk frequently arises. Solvency Summon's definition of discontinuance is exceptionally broad. It encompasses surrenders, lapses without value, making a contract paid up, automatic non-forfeiture provisions, or exercising other discontinuity options, or even not exercising continuity options.
So really wide-ranging.
Very. If your MLR treaty's definition of lapse is narrower, uses different terminology, or doesn't precisely fit this comprehensive solvency concept, you face a significant problem.
What kind of problem?
The specific type of discontinuance that might most negatively affect your basic own funds, the one that generates the largest loss in a stress scenario, might not actually be covered by your reinsurance treaty. Yeah. You might think you're protected for the full scope of Solvency II's definition, but the treaty's more restrictive language could leave you materially exposed to a portion of the risk you intended to mitigate. It's crucial to match the language. Now, let's talk about the fine print that keeps many risk managers up at night. Exclusions. These are standard in any insurance or reinsurance contract designed to manage exposure or keep premium costs down.
True.
But the standard formula mass lapse scenario has no exceptions. It covers all events regardless of cause. Why are these exclusions particularly insidious when the standard formula has such broad coverage? It sounds like a clear, immediate red flag for basis risk.
It's a huge red flag and a critical point. While exclusions might be designed to reflect very low probability events, we must remember that mass lapse events themselves are extreme low probability scenarios, calibrated at a bare 99.5% confidence level.
Right, the 1 in 200-year event.
Exactly. So those exclusions, even if they seem to cover rare events, can indeed represent a material share of the potential cases that could lead to a mass lapse event that the standard formula expects you to capitalize for. The standard formula's mass lapse scenario doesn't differentiate based on the trigger.
Doesn't care why.
Right. Whether it's a financial crisis, widespread unemployment, a major scandal, or legal changes that captures the impact, if your treaty excludes certain triggers, you could have a significant basis risk, leading to a misrepresentation of your true capital position.
Can you give us some concrete examples of these problematic exclusions that 𝗖𝗂𝗃𝗍 has observed so risk managers know exactly what to look out for when they pore over their contracts?
Certainly. Some common problematic exclusions that 𝗖𝗂𝗃𝗍 has observed include mass lapse events specifically triggered by changes in legislation, such as new taxation rules that make policies less attractive.
Okay, legislative risk.
Yes. Also concerning are exclusions for lapses due to a worsening financial position of the undertaking itself.
So if the insurer gets into trouble.
Right. Or extensive market behavior, like large-scale transfers from defined benefit to defined contribution schemes, or even events stemming from broker recommendations or other third-party actions influencing policyholder behavior.
Wow, that covers a lot.
It does. Even internal switching between the ceding undertaking's own products or splitting them, if excluded, can be an issue, because these are all potential drivers of collective discontinuance. If your MLR treaty excludes these types of events, it means you might not be getting the capital relief commensurate with your true holistic risk profile under Solvency II.
But some exclusions are okay.
Yes, there's an important distinction. Exclusions of events solely within the ceding undertaking's control, those intended to prevent moral hazard, where the insurer actively causes the lapse event to trigger a claim, are generally acceptable and do not impair risk mitigation. They serve a legitimate purpose of aligning interests. 2.4. Basis for the calculation of the claim.
What if the MLR treaty defines the claim paid by the reinsurer using concepts other than those in Solvency II, like an economic loss or a loss in value in force, VIF? This sounds like it could create an immediate disconnect between what you pay for and what you actually get for solvency purposes.
This is a very frequent source of basis risk, and it can indeed create a significant disconnect. If the MLR treaty defines the claims to be paid by the reinsurer using parameters and concepts that differ from those used to calculate solvency technical provisions.
Like different discount rates.
Exactly. For instance, if the discount rates used for a value in force calculation are different from the Solvency II risk-free rates, or if the calculation methodologies diverge, you, as the undertaking, must be able to clearly explain these differences.
And justify them.
More importantly, you need to articulate precisely how these differences have been factored into your SCR calculation and, crucially, rigorously assess whether they create a material basis risk.
And it's not static.
No, the impact of these differences isn't static either. It can change over the one-year horizon of the SCR. Consistency in the parameters used to define claims, attachment points, and detachment points is absolutely crucial here. Any divergence adds unnecessary complexity, computational burden, and most critically, the potential for a material mismatch between the capital relief you're claiming and the true risk transfer that has occurred. 2.5. Fixing a lapse parameter.
Mass lapse events aren't usually instantaneous. They're more like a wave that builds, and the expected lapse rate can actually increase as the event unfolds. What's the risk if the treaty fixes the reinsurance claim based on the lapse parameters at the date the event occurs, rather than accounting for its dynamic evolution?
This is a subtle but incredibly significant point that many firms overlook. The amount of the reinsurance claim, that is, the actual loss in Solvency III Sec-owned funds, depends directly on the expected lapses over time. Lapses have a direct cascading impact on the profitability and valuation of the insurance contract portfolio. Therefore, if the MLR treaty defines the reinsurance claim based on the value of the lapse parameters, valid only at the date the mass lapse event is deemed to occur.
A single snapshot in time.
Exactly. The real risk mitigating effect can be significantly lower than what was initially assessed or assumed. The risk transfer in such a scenario may not be effective or commensurate with the capital relief you're seeking because the ongoing evolving impact of the lapse event isn't fully captured by these fixed parameters.
Like taking a photo of a moving train.
And expecting that snapshot to tell you its entire journey.
Yeah.
The reality of a mass lapse event is far more fluid, and your treaty needs to reflect that. 2.6. Cliff edge effect.
This sounds particularly important for risk managers because it gets at the very design of the standard formula. The standard formula mass lapse scenario is designed at VAR 99.5%, covering all losses up to that confidence level. How can an MLR treaty create a cliff edge effect around its attachment point that fundamentally undermines this comprehensive coverage? It almost sounds counterintuitive for a reinsurance contract.
This is a critical area of concern for regulators, and it's where seemingly minor wording can have profound implications. Most MLR treaties are structured so that the claim paid by the reinsurer is the loss exceeding the attachment point.
The excess part.
Right. For example, if your attachment point is 15% and detachment is 40% and the actual lapse rate is 35%, the treaty covers losses from lapses between 15% and 35%. This is generally acceptable and works within the standard formula.
Okay, that makes sense.
However, some problematic treaties define the claim as the loss associated with all lapses once the lapse rate exceeds the attachment point.
All lapses? How does that work?
So if the actual lapse rate hits 35% and your attachment is 15%, the treaty suddenly covers all of it, from 0% up to 35%.
So if the actual lapse rate is, say, 35%, the treaty kicks in and covers all of the losses from 0%. Why is that a problem when it sounds like more coverage? It's like a fire insurance policy where instead of covering only the damage above a certain deductible, it suddenly pays for all the damage from 0, but only if the damage exceeds a very specific threshold.
Right.
And if it's just below that threshold, you get nothing. It seems to create a massive all-or-nothing gamble. Is that right?
You've nailed the analogy perfectly. That's exactly why it creates material basis risk within the standard formula, because it generates a sharp artificial discontinuity in coverage.
A cliff edge.
Exactly. The MLR treaty effectively transfers all losses for scenarios where the lapse rate is above the attachment point, but no losses for scenarios where the lapse rate is below it, even if those scenarios still incur substantial losses for the undertaking.
But real losses don't work like that.
Precisely. Conversely, the real losses from your underlying lapse exposure constantly increase as the lapse rates rise. There's no sudden jump from zero to full loss coverage at an arbitrary point. Allowing for such a risk-mitigating effect would lead to a non-commensurate SCR reduction.
How so?
The capital relief could be a full 100% of the mass lapse requirement, while the treaty only actually covers a subset of the scenarios, leaving you entirely exposed to events just below that attachment point.
So it looks better than it is.
Much better. Therefore, 𝗖𝗂𝗶𝗂𝗍 has stated that this type of treaty would typically require a partial or full internal model to accurately measure its true risk-mitigating effect, as the standard formula simply cannot adequately capture such a discontinuous transfer. It's an enormous drain on resources for a potential mirage of capital relief. 2.7. Attachment-detachment points.
We often see detachment points aligned with the 40% standard formula stress. But the attachment points level is incredibly critical, isn't it, in terms of both the risk you retain and the cost of the reinsurance?
Absolutely. The attachment point dictates your retained risk, and it's a delicate balance. While a lower attachment point for the reinsured firm can reduce the undertaking's net loss in a mass lapse event, the pricing doesn't always behave linearly with the probability of lapses.
Meaning?
What we often observe is that reinsuring the final 10% of lapses, for example, the segment from 30% to 40% over assumed best estimate lapse rates, is frequently significantly cheaper than reinsuring the first 10%, say, from 0% to 10%.
Even if the SCR relief looks similar.
Exactly. Even if the capital relief for your SCR calculation might appear similar for both scenarios. This is because the probability of hitting that higher final 10% band is statistically much lower.
So this doesn't automatically mean the risk transfer isn't commensurate, but it requires incredibly careful calibration and a deep, deep understanding of your own portfolio's specific lapse characteristics.
Precisely.
It sounds like you really have to earn that capital relief.
You do. The non-proportional nature of MLR means the capital relief can seem similar for different attachment points, even if the cost varies significantly. However, the critical point for you, as the risk manager, is to consider the real risk profile of the reinsured portfolio.
Not just the whole company average.
Correct. It's not enough to say your overall firm's risk profile aligns with the standard formula. If you, for example, only reinsure mass lapse events for a portfolio of insurance products that inherently have a very low lapse risk, but the attachment point in your MLR treaty isn't specifically calibrated to that specific portfolio's low risk,
then the relief might be too high.
Exactly. The capital relief you're taking might not be commensurate with the real risk transfer that's actually occurring. This granular assessment of the mass lapse risk profile of the reinsured portfolio must be a key part of your own risk and solvency assessment, or RSA. This is where your models and data meet the contractual reality. 2.8. Measurement period.
You've highlighted that real mass lapse events aren't instantaneous. They unfold over time like a slow-motion catastrophe. How does the measurement period of an MLR treaty need to be designed to truly capture this dynamic and ensure effective, continuous coverage?
Okay, the measurement period is essentially the risk window or cover period, the time frame over which lapses are aggregated to potentially trigger a claim.
Got it.
Since real events can span longer periods than a fixed calendar year, for instance, a mass lapse event that starts in July wouldn't be properly covered by a treaty with fixed cover periods coinciding only with calendar years.
You'd miss part of the event.
You could, yes. This potential mismatch can be mitigated by using rolling measurement periods and ensuring a sufficiently long duration for the treaty. A good example might be a 12-month measurement period that rolls over quarterly.
Rolling quarterly.
Yeah, meaning every quarter, a new 12-month period begins. This effectively ensures continuous coverage for an unfolding event, no matter when it starts.
And what about high watermark clauses? They sound problematic for sustained coverage, almost like a decreasing benefit.
They can indeed be highly problematic, and you're right, they lead to a diminishing level of ongoing cover. Some MLR treaties regrettably include these clauses, which require the deduction of past claims already paid within the treaty from the current claim calculation, especially for non-overlapping measurement periods.
Like using up your limit?
Sort of. For example, a 24-month high watermark clause in a 12-month measurement period treaty. De facto, this type of clause leads to a permanent increase of the attachment point after each mass lapse event that has been covered by the MLR treaty.
So your trigger point goes up each time.
Effectively, yes. This significantly reduces the ongoing cover for subsequent periods. Undertakings must carefully consider and model the impact of past claims on the cover provided by the MLR treaty in the following 12 months.
Are there exceptions?
Well, in truly exceptional cases where an undertaking's specific risk profile suggests that a material share of lapses would occur beyond the first 12 months. For instance, if policyholders can only surrender their contracts annually, not at any time, a longer measurement period might be necessary to ensure the adequacy of the standard formula for mass lapse risk, as a rolling 12-month period may not suffice. It's a key area for careful actuarial and risk modeling. 3. Broader operational and regulatory implications.
We've meticulously pulled apart the MLR treaty itself, clause by clause, identifying the hidden dangers within its structure. But even with a perfectly crafted treaty, the story doesn't end there. Let's zoom out now and look at the ripple effects, the broader operational and regulatory implications that can still trip you up.
Right, it's not just the contract terms.
One critical area that often gets overlooked, but can severely impact your firm during a crisis, is liquidity risk. How does MLR, ironically, not eliminate this particular vulnerability?
That's a critical operational risk often overlooked in the pursuit of capital relief. MLR treaties, no matter how perfectly structured, do not eliminate liquidity risk arising from mass lapse events.
Why not?
Well, your firm can still be significantly exposed due to the inherent time gap between when the lapses actually occur and when the reinsurer pays the claim.
Right.
Cash goes out, but the reinsurance money hasn't come in yet.
The timing mismatch.
Exactly. This exposure is compounded if there's a poor definition of terms in the treaty, which can easily lead to disputes and further delays in payment. Undertakings must explicitly address this in their liquidity risk management system, which is a core requirement under Solvency II.
So plan for that delay.
Yes. This means carefully considering the specific features of the MLR treaty, including all contractual arrangements and any existing deposits, specifically to account for that potential time lag between the outflow of cash due to surrenders and the inflow of cash from the reinsurer. You can have all the capital in the world, but if it's not liquid when you need it, you still have a problem.
Let's turn to termination clauses, which 𝗖𝗂𝗶𝗂𝗃 has also issued an opinion on. These can seem like standard contractual features, providing necessary flexibility, but they can also fundamentally compromise risk transfer in ways that might not be immediately obvious.
Like a Trojan horse, yeah.
Almost like a Trojan horse within your contract. What should risk managers be looking out for here?
Termination clauses are indeed common and can serve legitimate purposes. They can ensure an equitable and operational contractual relationship, protect parties from severe unforeseen events, or even act as a trigger for renegotiation in changed market conditions.
Right.
But 𝗖𝗂𝗃's focus, and where the critical risk truly lies, is on those clauses that allow the reinsurer to unilaterally terminate the agreement.
Unilaterally terminate.
Yes. These are the clauses that can create significant basis risk, effectively undermining the assumed transfer of risk precisely when it's most desperately needed by the ceding undertaking. If the reinsurer can simply walk away when things get tough, the capital relief you've taken might be illusory, and that's a huge concern for regulators. 3.1. Discretionary termination clauses.
Okay, what if the reinsurer has a purely discretionary right to terminate the contract without any prior specific condition being met? It sounds like a get-out-of-jail-free card for the reinsurer right when you're most vulnerable.
You've hit on the core concern perfectly. It is indeed highly problematic. Such clauses are explicitly expected to endanger effective risk transfer because the reinsurer would have the unfettered option to terminate the contract precisely when lapses are approaching the attachment point, the very moment the coverage becomes most valuable to the ceding undertaking.
So they can pull the plug just before paying out.
Potentially, yes. Therefore, contractual arrangements giving the reinsurer such an unfettered option to unilaterally terminate the contract early without any prior conditions are generally not eligible as RMTs to reduce the SCR.
Generally not eligible, any exceptions?
The only exception is if the undertaking can definitively demonstrate that even with such a clause, the residual measurement period and the residual duration of the treaty are still sufficient to ensure an effective and continued risk transfer. This is an incredibly high bar to meet in practice, and it's rarely achievable for a truly discretionary clause. 3.2. conditional termination clauses.
What about clauses allowing termination under more specific circumstances, like the insurer's insolvency, a regulatory authority's decision to restrict business, or if the cedent's solvency second ratio drops below a certain level? These sound like valid contingencies, but they also could coincide with the very events that cause mass lapses, putting you in a double bind.
You're absolutely right to highlight that dangerous coincidence. These special termination clauses, particularly if they allow for short notice periods, meaning an insufficient residual measurement period or duration of cover, are indeed expected to create basis risk.
Why?
Because some of these very specific events, like an insurer's financial deterioration or regulatory intervention, can either trigger a mass lapse event or be triggered by an ongoing mass lapse event.
The trigger and the termination condition are linked.
Exactly. If the reinsurer can terminate the treaty under these precise conditions, those critical mass lapse events, which are precisely what you sought to cover, could be indirectly excluded from coverage. This undermines the very purpose of the reinsurance.
Are any conditional clauses okay?
Yes, again, it's important to distinguish. Special termination clauses that only apply when events are solely within the control of the cedent, again, to prevent moral hazard, where the cedent actively causes the trigger, are generally acceptable and are not expected to create material basis risk. The line here is drawn at events outside your direct control, but which are correlated with the risk being transferred. 3.3. Releasing from obligations and asset retention.
This is critical. What if a termination clause allows the reinsurer to be fully or partially released from its obligations for legitimately incurred losses, or to unconditionally retain transferred assets upon termination, especially in cases of the cedent's insolvency or regulatory administration?
Right.
This sounds like a fundamental violation of the spirit of reinsurance and policyholder protection.
This is, without doubt, a major concern and a clear regulatory red line that 𝗖𝗂𝗶𝗀 takes very seriously. Such clauses are not considered to effectively transfer risk for solvency calculation purposes.
Flat out no.
Pretty much. This arrangement directly prejudices the fulfillment of reinsured insurance claims in case of the ceding undertaking's insolvency or administration, and it creates a disproportionate contractual balance between the rights and obligations of the ceding undertaking and the reinsurer.
Tilts the scales unfairly.
Dramatically. If a reinsurer can simply walk away with assets or avoid paying valid claims when the cedent is in distress, it raises profound questions about genuine policyholder protection. National competent authorities might even consider prohibiting the free disposal of assets that are located within their territory following such a transfer, because it undermines the entire protective function of the insurance system.
And beyond policyholder protection, it seems like this spirals into broader organizational integrity issues impacting governance and fitness and propriety for the individuals running the firm.
Absolutely. These situations raise very serious questions regarding the undertakings and groups' application of the prudent person principle, which is a cornerstone of Solvency II.
Prudent person principle?
Yes. They also scrutinize the overall system of governance and, crucially, the fitness and propriety of individuals running the undertaking, including those in actuarial and risk management functions.
So it reaches right up to the top.
It does. Regulators will look at factors like the timing of the agreement signing, whether it's an intergroup reinsurer, and the specific terms of the contract. It's not just a technical compliance point. It's a very serious operational risk and integrity issue for senior management and board members, because it indicates a fundamental flaw in how risk is being managed and capital is being accounted for.
Now let's consider the other side of the coin, the reinsurer. How should undertakings applying the standard formula classify and calculate the capital requirement for mass lapse risk when accepting it through an MLR treaty? I wonder if there's a common misstep here.
There definitely can be a misstep, and it's a significant one. The party accepting the risk in an MLR treaty, the reinsurer, is undeniably exposed to life health mass lapse risk, as a widespread mass lapse event would naturally trigger these treaties.
Makes sense. They're on the hook.
Right. The standard formula appropriately supports this. For reinsurance treaties, the mass lapse capital requirement must be assessed based on the underlying direct insurance contracts in the life health underwriting risk module.
So treat it as life risk.
Exactly. This ensures that the true economic nature of the risk is reflected in the reinsurer's solvency capital, maintaining a consistent capital treatment across the value chain.
What's the risk if they don't do this? I've heard about cases where reinsurers classify it as non-life risk, which seems like a fundamental miscategorization and could lead to some significant regulatory arbitrage.
This is a serious issue that regulators are actively addressing because it leads to a material underestimation of the SCR and allows for what's effectively regulatory arbitrage.
Arbitrage, okay. How?
If the reinsurer classifies the accepted mass lapse risk as, say, a non-life risk, and therefore doesn't calculate a life mass lapse capital requirement, you have a major disconnect. The cedent might get a substantial SCR decrease,
Big capital relief for them.
which is a significant capital benefit for them, while the reinsurer's SCR only increases marginally, perhaps by only 5–10% of the cedent's reduction, because non-life capital requirements for lapse risk are typically much lower.
So the total capital held against the risk drops significantly.
Exactly. This approach fundamentally fails to recognize the true economic nature of the underlying risk, which originates from life insurance policies and is directly against Solvency II SIC principles. It creates a situation where the overall capital in the system for this risk is artificially reduced, which is precisely what 𝗖𝗂𝗶𝗀 wants to prevent to maintain financial stability and ensure robust policyholder protection.
Let's turn to the balance sheet implications, specifically for risk margin calculation and the valuation of reinsurance recoverables. What are the complexities here, particularly with projecting MLR renewals for long-term contracts that might outlive the reinsurance treaty itself?
This is another area of significant nuance and actuarial complexity. When you're projecting future SCRs associated with long-term contracts, which can last significantly longer than a typical reinsurance treaty, you necessarily need to make assumptions on the potential replacements or renewals of reinsurance contracts, including MLR treaties.
Assumptions about the future market.
Right. These assumptions can have a material impact on both the calculation of your risk margin and the valuation of your reinsurance recoverables. The delegated regulation allows for considering the renewal or replacement of reinsurance for SCR projection within a 12-month future period, subject to certain conditions.
Okay, for the next year.
Yes. However, for risk margin calculation and the valuation of reinsurance recoverables, future reinsurance arrangements can be projected for as long as the underlying obligations, provided specific stringent conditions are met, as further clarified by 𝗖𝗂𝗶𝗀 guidelines on valuation of technical provisions. This allows for a more comprehensive long-term view, but comes with significant burdens.
And those conditions, particularly for MLR, are quite stringent, especially given that mass lapse reinsurance is still a relatively niche market, not a highly liquid one with abundant options, correct?
Exactly. The stringency is paramount due to the long horizons and the niche nature of the market. You must, as an undertaking, clearly justify that the risk of the MLR treaty not being replaceable due to an absence of liquidity in the market is not material.
Proving you can replace it if needed.
Yes, and that's a substantial hurdle given MLR specialized status compared to more traditional liquid reinsurance lines. Furthermore, you must accurately estimate the risk that the cost of replacing existing reinsurance arrangements may increase in the future, which requires robust market analysis and forward-looking assumptions.
Guessing future prices.
Essentially, yes. These justifications are particularly challenging for MLR due to its specialized nature and the typically very long projection periods required for the underlying obligations in life insurance. The uncertainty of these assumptions increases significantly, often exponentially, with a longer projection horizon. It's a key area where firms need robust methodologies and strong justification to their supervisors, backed by strong governance and expert judgment.
Finally, all this detailed assessment and due diligence we've discussed needs to be visible to supervisors and the public, right? Transparency is a recurring and fundamental theme in Solvency II.
Absolutely. Transparency is non-negotiable and foundational to regulatory oversight. In accordance with the delegated regulation, undertakings that have entered into a mass lapse reinsurance treaty are explicitly required to include detailed qualitative and quantitative information about such treaties in their supervisory reporting and public disclosures.
So lay it all out there.
Pretty much. This means not just stating that you have a treaty, but providing granular details on its terms, its impact on your risk profile, and your assessment of its effectiveness and any associated basis risk. It's about ensuring that regulators, and indeed the market, can fully understand the true risk profile and the extent of risk mitigation claimed by your firm, fostering confidence and market discipline. Outro.
What a deep dive today into the nuanced world of mass lapse reinsurance and those critical Solvency II compliance points. It's clear that from the clarity of terms to the precise definition of a lapse and the hidden implications of termination clauses, these aren't just minor contractual details.
Not at all.
They are fundamental to whether risk is truly transferred and if your capital relief is genuinely valid. For any risk manager listening, this isn't just about ticking boxes. It's about the very integrity and resilience of your firm's solvency position.
What's fascinating here is that every single MLR treaty demands an individual granular assessment. The one-size-fits-all approach simply doesn't work under Solvency II.
No shortcut.
No shortcuts. As we've explored, slight variations in definitions or clauses can fundamentally alter the effectiveness of the risk transfer and, consequently, the validity of any capital relief. The regulatory scrutiny on these non-traditional risk mitigation techniques is only increasing, and for good reason.
Why is that?
It's about ensuring real policyholder protection and financial stability across the industry, not just capital optimization that might inadvertently mask underlying unmitigated risks. It's about substance over form, really.
Substance over form. So for you, the risk manager, the question isn't just, do we have reinsurance in place to manage mass lapse risk? But rather, does this reinsurance truly do what we think it does in every possible scenario and under every regulatory lens, especially when things go wrong and the worst-case scenario materializes?
That's the core question.
What stands out to you as the most surprising or most critical hidden complexity in your firm's current risk mitigation strategies after this deep dive? Keep asking those crucial questions and exploring those often overlooked details, because true risk management often lies in the fine print.